Understanding return on revenue, a key measure of company profitability. Return on revenue, ROR, is a vital metric for assessing the profitability of a business based on the revenue it generates. It provides insight into how effectively a company can convert its total revenue into net income, serving as a gauge for operational efficiency, management effectiveness, and overall financial health. This article delves deeper into ROR, its calculation, significance, and practical applications in evaluating a company's performance. What is return on revenue? Return on revenue, also referred to as net profit margin, takes the net income of a company and divides it by its total sales revenue to express how much profit is generated from every dollar of revenue. Specifically, ROR reveals the percentage of total revenue that ultimately translates into profit after accounting for operating costs, taxes, and overhead expenses. In essence, it measures the effectiveness of management in generating profit while managing expenses. Key takeaways. ROR provides a clear indicator of a company's profitability. It allows investors to evaluate a company's sales generation and expense management capabilities. It's crucial for assessing the overall financial performance of a business. The formula for ROR. Calculating ROR is straightforward. The formula is as follows. Backslash text, ROR equals left, frac, text, net income, text, total sales revenue, right, times 100. Breakdown of components. 1. Net income. This is the profit a company makes after all expenses and costs have been deducted from total revenue. It includes cash and non-cash expenses such as depreciation. 2. Total sales revenue. This represents the gross income a company makes from selling its goods or services, adjusted for sales discounts and returns. How to calculate return on revenue. To compute ROR, follow these steps. 1. Determine net income. Subtract all operational expenses, including the cost of goods sold, COGS, operating expenses, taxes, and administrative expenses, from total revenue. 2. Calculate sales revenue. This number is found at the top of the income statement, usually referred to as total or gross revenue. 3. Apply the ROR formula. Insert net income and total sales revenue into the ROR formula. Example calculation. Suppose a company has a net income of $1 million and total revenue of $5 million. The ROR would be calculated as follows. Backslash text, ROR equals left, frac, 1 million, 5 million, right, times 100 equals 20%. This indicates that 20% of the revenue is retained as profit after expenses are accounted for. What ROR tells us. Analyzing ROR provides valuable insights for investors and business managers alike. It showcases how efficiently a company turns sales into profit, allowing for a relative comparison with competitors and historical performance. Profitability insight. A higher ROR indicates strong profitability and effective cost management, while a lower figure may reflect rising expenses that outpace revenue growth. Trend analysis. Monitoring ROR over time can reveal trends in profitability and operational efficiency. Performance comparison. ROR can be benchmarked against peer companies to gauge competitive positioning within the industry. ROR versus earnings per share, EPS. While ROR focuses on revenue generation translated into profit, earnings per share, EPS, reflects profitability relative to the number of outstanding shares of a company. EPS calculation. Backslash text, EPS, equals frac, text, net income, text, number of outstanding shares. Both metrics reveal profitability, but they apply to different contexts. ROR illustrates management's efficiency in handling sales and expenses, whereas EPS indicates shareholder profit per share owned. Practical application. a real-world example using Apple Inc. To illustrate ROR's significance, let's examine Apple Inc.'s financial performance. For the fiscal year ending September 28, 2019, Apple reported net sales, $260 billion. Net income, $55.2 billion. Using the ROR formula. Backslash text, ROR equals left, frac, 55.2 backslash text, billion, 260 backslash text, billion, right, times 100 approximate 21 %. This indicates that Apple retained 21 cents of profit for every dollar of sales revenue. Investors evaluating this ROR would compare it against other tech giants and analyze trends over various fiscal periods. Conclusion. Return on revenue, ROR, serves as a fundamental measure of a company's profitability and operational efficiency. It provides stakeholders with insights into how effectively a business manages both sales generation and expenses. While useful on its own, ROR should be evaluated alongside other metrics, such as EPS, to gain a holistic picture of a company's financial health. By understanding and analyzing ROR, investors and business managers can make informed decisions to enhance profitability and drive sustainable growth.